Most people think you can only make money in the stock market by taking big risks. Stocks go up, you win. Stocks crash, you lose, right? But what if I told you there's a way to earn steady returns from the market with almost no exposure to stock price movements? This strategy has been hiding in plain sight, and it's called arbitrage funds. Before we go further, let me make one thing clear. I am not a certified financial advisor. This video is for educational purposes only. If you want to invest in arbitrage funds, consult your financial advisor first. Don't blindly invest. Here's the problem. Savings accounts pay almost nothing. Certificates of deposit, or CDs, lock up your money and still don't pay much. Even bond funds can be volatile when interest rates move. So where do you put your money if you want low risk, tax efficiency, and better returns than just letting it sit in the bank? That's where arbitrage funds come in. And by the end of this video, you'll know exactly 1. How they work. 2. Who should invest in them. 3. How much you can realistically earn. 4. And what the hidden risks are. Arbitrage funds exploit one simple idea: price difference. Let's say stock A is trading at $100 in the stock market. At the same time, its futures contract is trading at $101. An arbitrage fund will buy the stock at $100, sell the future at $101. That $1 difference is locked in, risk-free, no matter where the stock price goes. On expiry, the stock and the future price converge. Whether the stock shoots up to $110 or drops to 95s, the fund still pockets that $1 spread. Multiply this across hundreds of trades every day, and you get consistent, low-risk returns. Let's make this real. Suppose you invest $10,000 in an arbitrage fund. Typical annual returns range between 4 to 6%, depending on market volatility. So, in 1 year, you might make around $500. Compare that to a savings account that might pay you only $200 to $300, or a 1-year CD that ties up your money for about the same yield, without the flexibility. Here's the kicker. Arbitrage funds are structured as equity mutual funds for tax purposes in the U.S. That means gains may qualify for capital gains tax rates, which are often lower than your ordinary income tax rate. So not only are returns potentially higher, they're also more tax efficient than cash, CDs, or bond interest. Quick pause here. If you're finding this helpful, make sure to hit that subscribe button and turn on notifications. I post new finance videos every week, and you don't want to miss strategies like this. So, who should actually put money in arbitrage funds? If you want a short-term parking spot for extra cash, say a few months to a year. If you're in a higher tax bracket and want more efficient post-tax returns than savings interest. If you want exposure to markets but without the risk of stocks or long bonds. And especially during volatile markets, because price differences are bigger and returns are better. Now, no investment is perfect. Here are the risks. 1. Returns are not guaranteed. If market volatility is low, arbitrage opportunities shrink, and returns can fall closer to 3 to 4%. 2. Liquidity rules. Most arbitrage funds ask you to keep your money invested for at least 30 to 60 days, or you'll pay a small exit fee. 3. Not wealth builders. Arbitrage funds are designed for stability, not for doubling your money. Think of them as a smarter cash management tool, not a long-term growth play. To sum it up, arbitrage funds earn from price differences between stocks and futures. Expect 4 to 6% annual returns, sometimes higher in volatile markets. Tax treatment is more favorable than savings or bond interest. Best for short-term cash parking with low risk. If you're considering them, compare expense ratios and check the exit load period before investing. And once again, just a reminder, I'm not a certified financial advisor. This video is for educational purposes only. If you're interested in arbitrage funds, talk to your financial advisor first before making any decisions. If you want your money to work harder without unnecessary risk, arbitrage funds are a great option to explore. I post new finance content every single week. breaking down investments, strategies, and wealth-building hacks in a simple way. So go ahead and subscribe, turn on the bell icon, and join our community of smart investors. Thanks for watching, and I'll see you in the next video.